Guys, it's Dan here. In this week's episode, let's talk about how to spot early signs of inflation. So in this video, you will learn two things. First of all, what is inflation risk? So basically, why are we even tracking inflation and why does it matter to us? And second of all, I will show you two early indicators that will allow you or allow us to easily track inflation before it actually happens. All that being said, ladies and gentlemen, let's move on. Let's quickly talk about the inflation risk. Why does inflation even matter for our economies? Well, basically, when you look at the past 100 years, let's say, there are a lot of economic data and a lot of economists agree, the majority of economists agree, that the perfect inflation rate for an advanced economy is about 2% inflation target, okay? So each advanced country wants to have a balanced inflation of around 2% per year. That means that basically the prices, the general prices of houses, of consumer goods, of energy and all these things, on average they go up by about 2% a year. This is considered to be like the target. Why? Because if you are below this target, so let's say imagine your country like Germany or Japan, you have a very low inflation, like 0 or 1%. Well, low inflation usually leads to slow growth, and nobody wants slow growth because, of course, slow growth means less companies are being created, less people are being on the job market, and basically it means that there is less demand for, let's imagine, this bottle here, which is a consumer good, okay? So if less people are buying my bottle on a country level, of course, then of course it creates less jobs and less job opportunities and just slower growth, which is bad in general for the economy. On the other side, and what you have to understand here, the central bank of course doesn't want this low inflation environment, so the central banks here will lower the interest rates. That means that governments, companies and individuals have access to money cheaper, which means you can basically borrow cheaper, right? And with this cheaper money, you can do more things and usually it leads to growth. So this is the idea here behind a low inflation environment and the reaction of the central bank. On the other side, of course, you have the high inflation environment, let's say 4, 5, 6% or even more. For example, in the 80s in the US we had like 15 to 20% inflation, so that's not something we've never seen before. The problem what you have here, of course, when you have high inflation, it means that, imagine 10% inflation a year, it means that the prices are going up in general by 10% per year, which is crazy. It means that the economy is overheating, and in this case, of course, you need to find your balance back. And what does it mean? It means that the central bank, in this case, they will increase the interest rates, which means that it's going to be more expensive to borrow money. So the government, the companies, the individuals will pay more for their loans, and this generally will temper the inflation because it will cool down the economy in this case. So the first thing you have to understand about inflation, that the inflation target of 2%, is kind of given, and that's the objective. So now the question is, now that you know that, we know why we are tracking it. Now the question is, are there maybe some early indicators, early signs of inflation that we can spot by looking at some specific measures? The first indicator everybody is looking at when it comes to inflation, so what could be a warning sign, is the 10-year treasury bond. So that sounds very complicated, but you will see in my argumentation it makes perfect sense and it's very logical. So first of all, what is a treasury bond? Well, let me explain here, you will understand it, it's pretty easy to understand. Imagine this is the US government here, and the US government after the pandemic or during the pandemic, they need a lot of money for public spending, okay? So they need to get into more debt to finance all this new spending, okay? So what can they do in this case? Well, they will issue what is called a bond, and it means that they will basically say to the financial market, hey financial market, hey investors, we are the US government, we need some money. Please lend us some money and we pay you back with interest. This is what basically a treasury bond is, or government bond, okay? So in this case, so the US government is asking for money to the financial markets, and the financial markets, of course, a lot of investors are interested in buying US government bonds because they know they will never, the US government will never default, right? They will never go bankrupt, so they will always, as a lender, it's great to know that the counterparty is not defaulting because you know that your money is secured, right? Your loan is secured. So in this case, of course, the financial markets will lend to the US government, but of course they will not lend money for free. But for a 10-year period, they will say, we lend you money for 10 years for this interest rate. And this interest rate is exactly what all the, let's say, savvy investors are looking at, especially when it comes to inflation. So now the big question, why? Well, think about it for a second and look at this graph. And all the investors who have been studying finance and all these things, they know this, and especially when you look at the last 50 years. So first of all, look at the gray zones. You will see, for example, 2020 is gray because it's, of course, a recession due to the pandemic. 2008 is gray because of the financial crisis. 2000 we had the dot-com bubble. And then let's say especially 1980 is interesting with the oil crisis and everything, where you can see that the rates of the 10-year treasury bonds are peaking very high. So what is interesting about this stuff is look at left of the gray zones, and you will see that before the recession, the 10-year bond always increased, which means inflation is coming, and then big recession due to this high inflation, and kind of a crisis is coming, so the central bank has to react and to reduce the interest rates to cool down the inflation and to cool down the economy. To give you a great example, 1980, for example, look at, let's say, 1979 or 1978. As you can see, you have a huge increase in the yields, going from something like 12% to 15% or something like that over a year. So a very big peak. And this means basically that inflation was anticipated and inflation came, and bam, we had a big crisis. In 2008, it was pretty interesting as well, because you see that, of course, this was less big than in the 80s with the high inflation rate, but still in 2008 you have the same phenomenon. It goes up in 2007, 2006, 2007, it goes up for about a year, and then again, which means that investors are expecting inflation, and then boom, recession comes and financial crisis in this case. So now, why 10 years treasury bond? Well, 10 years is actually the perfect length, because 10 years actually are also the benchmark interest rate for all the mortgages and usually for lending in general. So 10 years are the perfect time actually, because everything which is very short, if you look at the treasury bonds for 1 year or 2 years, this is too close to see the reactions of investors. 30 years, of course, is way too long because it's way too much in the future. But 10 years is actually, well, what the investors are kind of sensing, if you want. So if you are right now, if you are lending to the US government, you can do it, I think, for about 1.5%, because the 10-year treasury bond is about 1.5 right now. So that means that as an investor, you can lend for 1.5% to the US government. And this is still a territory where it's completely okay. We are not expecting any inflation. But let's say, imagine it's going to go in the next couple of months. Imagine it goes from 1.5 to 2.5%. That means that the investors want higher returns for lending for the next 10 years because they're expecting the inflation to rise. And that would be a warning sign. And that's why all the savvy investors are looking very closely at the 10-year treasury bond when it comes to spotting early signs of inflation. Let's quickly talk about the second index investors are looking at when it comes to tracking early signs of inflation, which is the copper price. Again, you might say, that's strange, what's the relationship between copper price and inflation? Well, let me explain. First of all, well, copper is a commodity, and it's a great commodity, and that's why it's used in a lot of sectors such as construction, transportation, and telecommunications. So you see that it's used in a variety of sectors, so it plays a very big role as a commodity. What does it mean for us and for our inflation? Well, if the copper price is going up, it means that usually a lot of manufacturing is following. Why are you buying copper? Well, to build something or some transportation or to improve telecommunications, okay? So the increase of the copper price means that there is high demand, okay? People are buying a lot of copper. So to build something, which means that it leads to higher manufacturing, and this higher manufacturing means that there will be higher demand for, let's say, buildings, transportation, telecommunication, and all these things. So meaning people will spend more on these things. That means higher demand, and higher demand always means, or usually means, higher inflation. So you can see that the copper price, especially when it increases, usually is an early warning sign of, first of all, economy is doing well because we are building stuff, but in the long term it can also lead to higher inflation. That's why a lot of people watch this copper price carefully. By the way, the copper, a lot of investors always say that copper has a PhD in inflation, or they call it Dr. Copper, for the reason I just mentioned, because the copper price tells you a lot about what will happen, well, in the near future, and especially related to demand and following inflation. So now quickly, what's going on with the copper price right now? Are we in danger of inflation? Well, look at the copper price. That's pretty stunning, actually. A few months ago, early 2021, before the vaccine rollouts and all this stuff, you can see that the copper price was pretty low at around 2,200, something like that, or 2.2, sorry. And then it jumped in a few months with the economies reopening and all these things. It jumped from around 2.2 to 4.5 in 2 months or something, so which means it basically doubled, which is absolutely huge. So the big question related to inflation is, because the pandemic was very different, right? It's not a financial crisis, it's something we've never seen, or we have seen but 100 years ago. So it's not really compared to a financial banking crisis or something like that. So what happens basically here, and that's the big question, why is there such a jump in the in the copper price? Is it because companies and countries are just getting back to where they were in 2019 and were just stuck for a year and are now just building what they were missing out in 2020, let's say? Or is there so much money in circulation with the Federal Reserve and the US government pumping so much money into the system that everybody goes crazy and companies are overbuilding and these kind of things? So that's the big question. Will there be higher demand in the next couple of years? And will it lead to inflation, or is it just kind of a post-pandemic hit or something like that? So now we have talked about the 10-year treasury bond and the relationship with the inflation. We have talked about the copper price. So these are the two things you have to watch if you want to know the early warning signs of inflation, if you want to be ahead of inflation. So now that you know all that stuff, I wanted to tell you I post once a week, every Sunday, corporate finance, market finance video, always high value, or at least I try to make it high value. So don't forget to subscribe if you want to step up your game in finance. Also, don't forget to like, of course. Takes me 6-7 hours to produce such a video. So don't forget to like, of course. And well, I hope to see you soon next Sunday on the channel. Thank you very much. Thanks for watching. Bye bye, guys.